In early 2024, the Indian economy was running hot. Gross domestic product, a measure of a country's total economic output, printed sustained growth above 7%. Simultaneously, banks reported that their non-performing assets, or defaulted loans, had plummeted to multi-decade lows of just over 2%. Driven by expectations of absolute political continuity and aggressive reform mandates, investors flooded the market. By late 2024, this extreme exuberance had pushed the BSE Sensex toward an all-time high of 86,159. Then, the election mandate required the formation of a coalition government, injecting an immediate layer of policy uncertainty. The market reaction was violent, resulting in a single-day drop of up to 8.5%. This chart shows the grueling distribution phase that followed between 2024 and 2026. The Nifty50 oscillated violently in a series of technical recoveries and aggressive sell-offs, ultimately delivering negative aggregate returns to investors. A consistently booming real economy resulted in a bleeding negative return stock portfolio for the retail investor over a 2-year period. To understand exactly how this bizarre paradox happened, we have to look under the hood of the market. The fundamental disconnect lies in how we measure economic health versus financial assets. Gross domestic product is a trailing indicator. It measures the physical goods and services a country has already produced. The stock market is a forward-looking leading indicator. Share prices do not simply mirror the current economy. They represent the current value of future corporate earnings, adjusting in real time for liquidity premiums and systemic geopolitical risks. While the factories and service centers were operating at full capacity, the equity markets were being battered by 7 compounding macroeconomic factors. Together, they formed a perfect storm that evaporated market liquidity. By late 2024, Indian equities were priced for absolute perfection. Investors had aggressively priced the next several years of assumed earnings growth into current stock values, leaving zero margin of safety for external shocks. We can measure this extreme premium using the Buffett indicator, a metric championed by Warren Buffett that compares the total value of a country's publicly traded stock market to its entire gross domestic product. This gauge shows India's Buffett indicator surging to 136%, making the market vastly larger than its economic output. Foreign investors noticed the glaring difference. While India traded at an extreme premium, China's ratio stood at 65% and Brazil at 37%. Recognizing this massive disparity, foreign capital initiated a massive tactical rotation. Foreign portfolio investment, short-term hot money in secondary stock and bond markets, began to aggressively exit India in search of cheaper valuations. In 2025 alone, these foreign entities liquidated roughly 1.66 trillion rupees from Indian secondary markets. By early 2026, the panic accelerated, hitting a withdrawal rate of 1,000 crore rupees for every single hour the market was open. This capital didn't just disappear. Rising interest rates from the U.S. Federal Reserve improved the yield on risk-free dollar-denominated assets. Global capital violently rotated away from expensive emerging markets toward the safety and high yield of U.S. Treasury bonds. As capital fled, India's deepest structural vulnerability was exposed. The nation relies on external sources for roughly 85% of its crude oil requirements. This map shows the Strait of Hormuz, a maritime choke point responsible for 25% of global seaborne oil shipments. In early 2026, the escalation of the Israel-Iran conflict directly threatened this vital supply line. The global energy markets panicked. In a few weeks, Brent crude prices spiked 40%, jumping from roughly $69 a barrel to over $110 by mid-March. To purchase this highly expensive dollar-denominated oil, massive amounts of rupees had to be sold on the open market. This immense selling pressure crashed the Indian rupee to a record low of 92.47 against the US dollar. This currency depreciation created a phenomenon known as imported inflation. When a nation's currency loses value, every single component brought in from overseas, from crude oil to heavy electronics, becomes instantly more expensive, injecting high costs directly into the domestic economy. For foreign investors holding Indian stocks, a depreciating rupee destroys the value of their returns when converted back to dollars. This triggered algorithmic trading systems to dump even more shares, compounding the foreign capital exodus. To fight this imported inflation, the Reserve Bank of India, the country's central bank, was forced to hike policy interest rates. High borrowing costs combined with soaring input prices directly crushed the profit margins of Indian corporations. This chart shows the reality check during the third quarter of fiscal year 2026. While top-line sales grew, raw material and operational costs surged by nearly 14%. Unable to pass costs to consumers, corporate net profit growth suffocated to a mere 5.1%. Historically, the information technology sector served as India's most reliable growth engine. Now it faced a dual threat: global clients delaying long-term deals due to macroeconomic fears, and a structural crisis known as AI deflation. The rapid adoption of Gen AI, generative artificial intelligence systems capable of creating complex text and code, allowed clients to demand immense cost reductions. While internal productivity improved, Indian IT firms faced severe margin pressure, resulting in a near freeze in entry-level hiring. This hiring freeze cascaded into a localized youth unemployment crisis. By 2026, nearly 40% of educated youth between the ages of 15 and 25 were without jobs. Millions of graduates lacked the stable, salaried roles needed to drive discretionary spending. The compounding pressures of job scarcity and high inflation choked off urban middle-class consumption, finalizing the stagnation of corporate revenue projections. Given this massive compilation of negative data, we have to ask a critical question. Foreign institutional investors, large global entities investing in Indian markets, pulled out over 2.6 lakh crore rupees across 15 months. Why didn't the benchmark indices crash by 30 or 40%? The Indian market only experienced a fraction of that expected correction because of the unprecedented rise of domestic institutional investors, like local mutual funds, and the retail investors powering systematic investment plans, or SIPs. This chart shows who stepped up to absorb the supply. During the early 2026 sell-off, domestic money purchased 1.16 lakh crore rupees, neutralizing the foreign flight. The foundation was the retail investor. 9.25 crore active SIP accounts pushed monthly inflows to all-time highs. Indian retail capital has matured. It evolved from speculative, short-term trading into serious, long-term wealth formation, serving as the ultimate shock absorber for the national macroeconomy. Moving into 2027, the era of passive, broad market index rallies is over. The most statistically probable path forward is a slow, grinding, range-bound recovery. This chart shows the new market reality: aggressive sector rotation. Capital is continuously flowing out of overheated, overvalued segments and rotating into value-driven, cyclical sectors like banking, which currently boasts exceptionally clean balance sheets. Geopolitical trade dynamics will dictate much of this rotation. With new reciprocal tariffs established with the United States, export-oriented capital expenditure will be forced to adapt, favoring specific manufacturing sectors. For the retail investor navigating this, the first actionable rule is to maintain SIP discipline. Stopping your investments during a time correction destroys the mathematical advantage of rupee cost averaging, the practice of buying more units when prices are low to reduce your average cost per share over time. Second, avoid high PE microcap bubbles. PE, or the price-to-earnings ratio, measures how much you are paying for every rupee of a company's profit. Companies trading at exorbitant multiples without real earnings growth will face brutal corrections. Instead, align your portfolio with long-term, government-backed themes like core manufacturing and infrastructure. While the market's current trajectory is sideways, the underlying foundation of the Indian economy remains remarkably strong. Navigating this paradox doesn't require panic. It simply requires patience, structural